Hey, what's going on, guys? I'm Dr. Boyce Watkins from the Black Business School, and a lot of you have been asking me about the IPO of the company Zoom. Now, let me say this: Zoom is a company that I figured would go public at some point, and that I knew would probably do pretty well. I mean, in terms of just making money. My experience with Zoom was that I used to use something called GoToWebinar, which was just this janky, outdated software, and it was so annoying because it couldn't do any of the things that we needed it to do. And so when we found Zoom, it was a no-brainer in terms of switching over. We really knew that it was the thing we'd been looking for. We'd been waiting for GoToWebinar to do what Zoom did, and they just became dinosaurs. And I think that's a good business lesson. I honestly believe that that's also what happened to Ebony Magazine and Johnson Publishing. I believe Johnson Publishing became a dinosaur because you can't make money, you can't make money in the year 2010 the same way you made money in 1988. That was Ebony's issue. Whereas with GoToWebinar, the technology they had was great maybe in 2007, but 10 years later, they had a lot of competition, and I feel like they lost. They became kind of the Blockbuster of, video conferencing technology. But anyway, with that said, the IPO went out, and and I got the numbers in front of me. The shares were originally released at $36 a share. It shot up to $62 a share on the first day, which is a huge jump. I don't really necessarily know if that's sustainable. But then again, nobody really knows. Nobody knows. I mean, I can give you speculation, but nobody really knows. That's what they call the random walk hypothesis in stock market investing. People pretend like they know, and then, if everyone makes a guess, then somebody's going to be right. But really, nobody knows what the stock's going to do, because if people knew, then the price would move according to whatever people knew, right? So if they know it's going to go down, then the price will go down because everybody knows that information. But anyway, it went up to $62 a share, and that kind of exemplifies the reason why a lot of people like to get in on IPOs, is because there's that potential for this massive jump. And you look at that 72%. I mean, that means if you put $10,000 in the morning, you'd have $17,000 by the end of the day. $7,000 earned just by investing. That's kind of crazy. But one of the things that you should know about IPOs is that, they're not always, they glitter, but they ain't always gold. There are a lot of IPOs that crash, when they first come out, that don't do very well at all. And, excuse me, I went running this morning, so I'm still trying to clear it. Whatever happens in your lungs when you go running. I would say though with Zoom, it was probably one of those special IPOs. I feel like the heavy institutional demand for the shares before it got released might be reflective of the expectation that the price was going to jump. I'll do some research on that. It's hard to get in on IPOs. It's hard to get in on hot IPOs. A lot of times you have to have a personal relationship with the owners of the company or with the people that run the brokerage firm that underwrites the IPO. The IPO shares typically go first to major institutional investors that manage billions of dollars, at least hundreds of millions of dollars. People that are, maybe within the brokerage firm that's underwriting the IPO, or special customers of the brokerage firm. It's really kind of a privileged man's game to some extent. It's hard for regular people to get in on IPOs. But at the same time, though, I don't necessarily see it as like this magic bullet, again, because some of the IPOs don't do well. And you could, if you have a brokerage account with somebody, you could ask them like, okay, can I get some sort of information on, new IPOs that are about to be released by your company. But if you have like apps like Acorn, Stash, and Robinhood, you can't really do that. You just buy the shares when they hit the market. And so I think it'll be interesting to see how Zoom does in the future. Sometimes there's this sort of exuberance when an IPO happens. People get super excited and everybody wants to buy it, because they get all hyped up about it. And I think I never forget that investing is a long-term venture, whether you're talking about crypto, real estate, or stocks and bonds. I didn't, like when the crypto market went crazy and crashed, it didn't really bother me that much because I'd made a lot of money from buying, early. And then I lost some of the money that I had just made, but it really wasn't my money anyway. I didn't feel like it was my money. And now I just still own the stuff. It's just going to grow over time, So never get caught up too much in the hype of investing. Investing should not be a casino. Investing should be a way of life. It should be a culture. And if you have the culture of an investor, then what you're going to find is that over time you'll just see your money accumulate, little pieces here and there, and put some energy in it. Just like if you think about it, if you were to add up all the money you've spent at the mall or on going out to eat or on basic stuff, fast food, shoes, things like that. Imagine if you were as aggressive in putting money into your investments as you were into putting money into whatever you spend your money on. Well, over time it's going to accumulate pretty fast, in maybe 3, 4, 5 years or more. And it becomes something worthwhile. So how do I feel about Zoom? I don't know. I'll watch it. I may go in and buy some shares just to add it to my portfolio. But if I buy it, I'm not buying it as a silver bullet. I'm not buying it as like, oh yeah, I just know Zoom is gonna be my big win. No, it's like, okay, sure, add it in. I have hundreds of other things I bought. I don't even know what I bought. Like for example, the other day, I noticed a little bump in the portfolio, and I saw that Disney had just shot through the roof, and I was like, "Oh, nice!" And I was like, "Okay, let me see if I own any Disney." I can remember how much Disney I own, and I was like, "Oh, yes, I own Disney." But it's that's kind of what it is. You diversify, you invest, broadly, not sort of picking one particular stock. So people wanted my opinion on the Zoom IPO. I think Zoom's a great company. They're very solid. If you want to know why I'm probably going to invest in Zoom, I kind of feel like this IPO price is a little high. Like 72% in one day is a huge amount of mispricing. Like when they release an IPO, they kind of release it based on what they think it's worth, what they think the company's worth. So when the value jumps 72%, the company didn't become 72% more valuable in a day, from a fundamental standpoint. So I really do feel like perhaps this could be a little bit of Alan Greenspan, the old chairman of the Federal Reserve, used to call irrational exuberance, and that's what I'm kind of seeing with this. I think it might be a little irrational, so I think I might wait until maybe when the market kind of dips a little bit and has a bad day, and then Zoom just sort of drops and gets back to normal, or maybe when all the people take their profits and start selling and the price drops because of that, then I might pop in and see what it's looking like then. So anyway, that's my 2 cents on Zoom. I'm out of here, guys. If you want to learn more about stock market investing, I have a great class in the Black Business School. It's theblackstockmarketprogram.com, theblackstockmarketprogram.com. You can get the first month free. So feel free to go check that out. So I'll see you guys soon. Have a great day. Talk to you later. Bye-bye.